So President Trump's trade wars are driving some companies to do things that they normally would not do. We're hearing reports that companies are rushing to ship out product before certain tariffs go into effect, so they're trying to beat the clock. Things do look really good right now, though. Earnings are expected to come in for S&P companies up 21%, but is this as good as it gets? Burke Financial CEO John Burke says, well, yeah, but for a time we're going to be pretty decent, right?
Liz, earnings are fantastic, and I've heard many commentators say that the market is ignoring the tariff talks, but actually the market should, if earnings are up 25% in the first quarter, now the expectations are closer to 24% because they're going up as these earnings come out.
Well, I think that's fantastic, 24%. What's bad about that?
Terrific, and the market should be following the earnings up, but the market's not following the earnings up because of concerns of tariffs. And even that, GDP is expected to be possibly 5% this quarter, which is fantastic. But perhaps some of that is because businesses are getting some of the goods out the door before they've got to pay tariffs. And perhaps this is as good as it gets.
Okay. So what do I do as an investor? Because I heard that from some experts 2 quarters ago when we were at 18% earnings growth, which to me is pretty phenomenal. Then we were at 19% last quarter. Now we're expecting 21, 22% by the time all is said and done. Now you say 24%. So what do I do now to protect later, or is it too early to make that move?
Well, Liz, I would say that if stocks had moved up in tandem with earnings, that you'd want to get out, but they haven't. So in a way, it's like having a bear market that you didn't notice. That is, that earnings went up 24, 25% over the last 2 quarters. And stocks barely moved 3% on the even-weighted S&P 500 index, 3%. So the stocks have lagged behind by over 20%. So if that's like a bear market, they've got over 20% cheaper because earnings went up and they stayed where they were. So therefore, stocks are now much cheaper than they were at the end of the year last year, and that should be our margin of safety.
What stocks fit into your thesis here then?
Well, you look this morning, Johnson & Johnson reported earnings. Johnson & Johnson's one of only 7 AAA rated. Their debt is only one of 7 AAA rated companies in the S&P 500. Yet they're growing their top line by 8%, which is terrific. You add your top line growth to earnings, dividends, etc., and you've got the mix of double-digit returns on a low-risk stock. So that's a company that we like.
And you like Cisco and Pinnacle, but any one of these companies, but particularly J&J, could be in the sights of the president, who sometimes goes after these companies for charging consumers too much.
Yeah, Johnson & Johnson, you get a little bit more safety as far as the other pharmaceuticals because they're only about half pharmaceuticals. The rest is going to be
medical devices,
consumer products. But yes, that's been the concern. But so far, the pharmaceutical stocks have done quite well this year.
John, it's great to have you, and you got nearly $500 million in assets over at Burke Financial. Good luck to you. Grow it for your clients, and thanks for sharing your ideas. We appreciate it.